good afternoon to all the participants. Good afternoon to those who are online. So welcome to CIEL Analyst Meeting for the annual presentation. So for those online, you are automatically muted as usual. So should you want to ask any question, you can use the Q&A function to do so. And we will take all the questions at the end as we do usually. So today in the room, so there's myself, Jérôme, Marc, Eric, Lakshman, Hélène, and Jean-Noël will be joining shortly. So just on the agenda so that you can review. Okay, we'll skip. Sorry. Okay, so I'll start with the group overview. So just what we wanted to do is to give you a bit of an overview of who we are and where we are. So today we operate in East Africa, where we have 16,000 collaborators. In Asia, where we have 12,000 collaborators, a bit more than 12,000. And in Mauritius, where we have 9,300 collaborators. Our turnover today is made from 57% from East Africa and Asia and 43% from Mauritius. So we derive about 50% of our turnover in hard currency today, and we operate on 11 markets through about 25 companies within our 6 clusters. So the group results, so just in a nutshell, group revenue increased by 8%. We issued also 1.4 billion rupees of sustainable linked bonds. And also we've seen a positive momentum on the share price. And I'm not going to go through the details as we're going to cover it in the presentation. So from a result perspective, so we had a growth in turnover, as I mentioned, to reach 38 billion rupees. We also had a decrease in EBITDA at 7.2 billion rupees versus 7.5 last year. So Jérôme will cover the details of his change in EBITDA. So which resulted in a group profit after tax of 3.8 billion. So a decrease compared to last year, where there were some exceptional items as well, and a group profit attributable to owners of 2.2 billion compared to 2.8 billion last year. We have also shared with you what it represents in dollars for those looking at it from external markets. Just from a ratio perspective, so the EBITDA resulted in a 19% EBITDA margin, a decrease compared to 21.3%, but still a very healthy EBITDA margin, even if we are aiming to improve at EBITDA margin. The group earning per share is at 1 rupee 28, which is a decrease compared to 1 rupee 66 last year, and a return on capital employed of 11.6%. So this year we have invested in a number of projects, and we will cover it just now. So we knew that it was going to impact the return on capital employed, but it's investing for medium-term to long-term value creation, and we'll cover that just now. So the company NAV per share is at 13 rupee 49, which is a slight increase compared to last year. Now what we wanted to do is to take the opportunity to talk a bit about our DNA and who we are and how do we operate, because there's the figures and then the way of operating. So you all know our purpose, you all know our values. We've communicated on that quite widely. But our ambition is really to deliver best-in-market growth from our investment portfolio through sustainable value creation. And to do that, we have launched this year our business principles that we cascade within our clusters. Each of our clusters, they have their own purpose, own vision, and own values. But the DNA of CIEL is important to us. And this business principle is, firstly, we value our people and build winning inclusive teams. Second, we prioritize customer satisfaction, excellence, and continuous innovation. We are pioneers and entrepreneurs, nurturing successful partnership across borders. We take accountability for our actions and uphold our values and ethics. And we champion sustainable practices to create long-term value. So that's very important for all our leaders across CIEL Group. Now, in delivering the strategy, and we'll go through it with Mark later, we have the foundation for the execution, which is based on 3 pillars. The first one being talent. We believe that talent will be a key in our growth. And to do that, we want to empower people to drive transformation. So, great place to work. We believe that culture and employee engagement is extremely important for us. So, what we've done is we embarked into a great place to work programs where today 19 companies are great place to work certified. So, at least 65% of employee engagement. And this program is continuing so that we want to roll it across the group. We have also our program of leadership development through HEC, where close to 200 managers has been trained over the last 4 cohorts that we had. And then we have our Go Beyond Gender programs, where we have achieved 35% of women at management level. Our target for that was 2027. From a sustainability perspective, is also very important to us. We'll talk about it later, but we have today our sustainable finance framework, which is well in place to be able to tap in sustainable finance in a very structured approach and make sure that all our capex are done in line with our sustainability strategy. So we raised the first of its kind in Africa sustainable linked bond of 1.4 billion. And what we've done as well, because our objective is to reach 80% of renewable energy by 2030, we have created a special vehicle where we are in partnership with some experts, Green Yellow being one, where all our renewable projects will be done through that vehicle. So within all our clusters, one for expertise, to be focused on capital allocation, and thirdly, we will end up in 5 years' time with a SPV with about 40 or 50 megawatt of renewable energy. And lastly, technology. We believe that technology will be extremely important for us going forward. So what we've done under the leadership of Mark, we have done a digital and AI maturity assessment across our clusters in a very structured process or framework with external parties. And based on that, each of the clusters, they have defined a clear roadmap to lead the way within the next 4 to 5 years in digital transformation and AI. And the assessment will be done every year to check the progress and together with the training that we're giving to all the clusters. So I'll hand over to Jérôme to talk more about the figures.
Thank you. Hello. Okay. So good afternoon, Guillaume, thanks. So Guillaume has given to the audience the key financial indicators of the financial year. I'm just going to review a few of the variance analysis compared to prior years so that you got a good idea of what is behind the figures. So we'll start with an EBITDA waterfall. So last year we were at just below 7.5 billion rupees, and we ended up this year at 7.2 billion rupees. We can see from going from left to right the positive moves in terms of clusters contribution. We had a very good performance, a strong performance from the healthcare cluster, followed by Sun Life in the hotel and resorts portfolio, which was also boosted by a part recognition on the profit on La Pirogue Residence project. We also had during the year some revaluation gain in the property and at BNI in Madagascar, which helped boost the EBITDA. And to a lesser extent, we had a positive contribution, additional positive contribution from the textile and Azure Financial Services, the treasury company of the group. Now, going on the right-hand side, we can see that where we had some shortfall compared to last year was the compression of the margins at BNI in Madagascar. So I believe Lakshman will cover it later on. We also had an impact of Riveo with both hotels being closed partly during the course of the year. We had the Shangri-La closed at the beginning of the financial year, and currently the Four Seasons is closed for renovation. So this has had an impact, quite an important impact on the contribution to the group. And last year, as Guillaume mentioned, we also the EBITDA was boosted by a one-off sale in the portfolio or property portfolio of Ferney, which was done there today. So now going to the PAT, so we can see the bar chart on the left that we had picked up to 5 billion in 2024. We're down to a little bit less than where we were in 2023. The main contributors, we've got a pie chart on the right, which shows you the contribution of each cluster to the group profit, to the attributable profit to the ordinary shareholders. We can see that textile is still leading. We own 100% of CIEL Textile. So 100% of the profit of CIEL Textile, 776 million, which represent 31% of the profit of the group, the profit attributable. Followed by finance, which we also own CIEL Finance, 100% of CIEL Finance. Though under underlying investment in the portfolio of CIEL Finance, we only own 50% of Bank One and 32% of BNI, our effective stake. So the contribution adds up to 562, closely followed by the hotel and resorts cluster with Sun Performance, where we only own 50.1%. So we've got quite a big share of minority in this cluster. And we've got the healthcare at 300 million level, representing 12% of the profit attributable, closely followed by the agro cluster at 182, down from last year, and we'll cover it later on. And the property cluster, which has benefited from some revaluation gain at 6% contribution to the group profit attributable. Now moving on to the free cash flow for the group. As you know, because we've, in the previous presentation we've made to you, we've only made a focus on our cash flow generation. So we can see that this year, fortunately, we're down compared to last year. If we look at the two columns on the right, you will see that we were at 4.2 billion last year of free cash flow, and we're down to 2.2. So we've got the three components of this free cash flow is the net cash from operation, where we're down a bit more than 1 billion rupees, which is mainly the shortfall on Riveo and the compression of the margin at BNI in Madagascar, which has led to around 950 million cash flow shortfall. We can see also from the working capital requirement that on the property sector, it's in fact the infrastructure linked to phase one, the farm living, which is going to be delivered very soon. So all the cost has been capitalized in inventories and therefore boosted the working capital requirement of a cluster. And also the textile, where last year there was a shrinkage in the production capacity at Tropic, which had freed a lot of working capital. And now with the expansion, the expansion we had in terms of capacity building in India at Laguna, we have increased the working capital requirement. So this explains the reason why we've got an additional working capital requirement compared to last year. And in terms of recurrent capex, maintenance capex, we are at about the same level as last year. Going to the indebtedness of the group, we can see that the level is very much commensurate to the industry. In fact, we compared to our peers, we're much lower than the peers. We are below the 30% mark, with a small increase during the year linked to mainly to the hotel and resort cluster in Riveo portfolio. We had a notes issued during the course of a year at Riveo hospitality level to finance part reimbursement of the MIC funding. So we refunded during the course of a year 1.1 billion of MIC funding. And we also had the various costs of renovation of the two hotels, which we financed through a notes issue to the tune of around 1.5 billion. Healthcare, quite an aggressive capex program, which results in better profitability, which Hélène is going to cover later on, so around 300 million. The property also with the infrastructure linked to the development of Ferney has used some working capital financing. So is CIEL, who has also ramped up in the capital of CIEL Healthcare and has therefore used its overdraft facility as a short-term financing availability to increase its stake. And finally, the working capital level at CIEL Textile, which has increased during the year, as I explained to you before. So we are current level at 2, debt to EBITDA ratio of 2, and a gearing just short of 30%. In terms of share price for the year, as Guillaume mentioned, that we have had a good momentum on the share price of CIEL. In fact, for the year up to June, we had a 14% increase, which is better than the Semdex and better than the MSCI Emerging and Frontier Markets. We even pick up at 1060 in October last year. And we were around the 950s to 10 rupees level until beginning of March, when Liberation Day, when the tariffs were announced by Trump. The stock market was corrected. We had quite a severe correction on our stock price, which is hovering between 850 and 9 rupees currently. Yesterday we were at 888. I think today we're at 886. So we paid 32 cents as dividend during the course of the year in July, and we had a discount to NAV. We still have a discount of 34%, which we are working on in order to reduce the gap. So that's basically the main highlights from a financial perspective. Now I'll pass on back to Guillaume and Mark for a review of the portfolio, and I'll come back for the agro-cluster later on.
Hi, everyone. From the overall valuation of the portfolio, as you can see from FY24 to 25, that increased by 4%. So it's largely driven from a hotel and resorts perspective by an increase of 20% in the combined share price of both Sun Life and Rivio. From a finance perspective, a 12% increase in NAV of the underlying assets of BNI and Bank One, driven by better forecast future cash flows. And then from a healthcare perspective, CIEL bought an additional 10% stake in CCIL, the C-Care holding company. And that price realization helped increase the valuation of the portfolio from a healthcare perspective. Yeah, so maybe just Mark last year presented to you our strategy framework, which was based on core businesses, adjacency growth, and then new frontier growth. So this framework is very much in place, and this is what we are following and sticking to it as a strategy. What we wanted to do is maybe to share with you where we are in that strategy from a CIEL Textile perspective. So we are focusing on the core. And although there's some headwinds from a macroeconomic and geopolitical perspective, from a textile perspective, our strategy towards India is very much on track, and Eric will cover that later, knowing that our US export in India represents only 20%. From a healthcare perspective, very much in line with our strategy, which is the growth leading position in Mauritius and East Africa, with a strong growth in EBITDA of 20% in Mauritius, 45% in Uganda, so which shows that our CapEx program of 2.3 billion over the last 3 years has been well materialized and is very well managed by the team. Just to say that we have increased our stake in CCIEL to 74.97% from 53%, where we invested, and Jérôme talked about it, we invested CIEL 785 million. From a finance perspective, although the performance is maybe below our expectation, and Lakshman will speak about it, we still believe in a lot of potential from a strategic perspective, and we are really focusing on the operational aspect of the bank, and Lakshman will cover that, knowing that our fintech investment is progressing as per plan. So CIEL Hotel and Resorts, what was interesting is the split between Sun Life and Rivio. We think that it is a success with a lot of emphasis now from Sun Life as a yielding business. And also we acquired 21% of Ambre for 721 million, so which we control now. And the La Pirogue Residences is a success, so which will be adding rooms to the rental pool of La Pirogue without having capex to disperse. From a Riveo perspective, we talked about the repositioning of the hotel. So Shangri-La is doing well. We are very happy with that. And Four Seasons is in the phase of renovation. And we are also launching some real estate project at the Shangri-La and also on Long Beach, which we're targeting to launch this year. The property Evoli strategy is on track, so we are very happy with that, and Jean-Noël will talk about it. From and Ferney also on track. From an agro perspective, the property is really driving Alteo's strategy. You've been to the Alteo probably analyst meeting. And then I'll hand over to Mark, where we'll talk a bit about our new growth drivers that we introduced last year.
Thanks, Guillaume. So maybe just to give a bit of context, so the new growth driver into India is really around what we call precision engineering manufacturing. And it's been a project that's been in progress for about the last 12 to 18 months. So initially we used a consultancy in India to help us to understand the Indian market for medical device manufacturing and which sectors we should look at in there. And our hypothesis was that we've got 20 years of experience, thanks to Eric's team and the CIEL Textile business in India. We understand manufacturing. We're in healthcare. So this could be a good adjacent industry to explore. And obviously the whole Indian growth story is a big growth story with 1.3 billion plus people. What CIEL Textile does is effectively contract manufacturing outsourcing, so CMO, for big brands, and then exports manufacturing out of India, exports globally. So in the medical device manufacturing, you have the similar business model from a CMO perspective, where you manufacture for the large brands. And our investment thesis behind this, or our strategy behind this, was to look for European partners that wanted to take advantage of the Indian growth story. They wanted a lower cost manufacturing base to manufacture in India for sale into India and then South Asia and potentially other emerging markets. So we managed to get we've signed a term sheet or MOU with a private equity owned French orthopedics manufacturing and distribution business. So that's knee, hip, and shoulder implants. So for the elder generation in the room, maybe some of you have had experience with that, but I'm still yet to have one. But it's actually a very high growth market, high margin market, and the cost of production that we can get out in India is a lot less than what they can do it in France. So they've been in existence for 25, 26 years. They've been in India since 2006 distributing. So we formed a JV where we have a 60% stake in manufacturing. So we're setting up a factory literally now, hoping to finalize that and the regulatory process they need to go through by the end of next year, and then actually start distributing what we manufacture from a knee perspective, because there's a price cap on the selling price of knees in India. So multinationals can't actually import knee into India, which is the biggest chunk of the market, about 80% value and volume. And then from a hip and shoulder perspective, we'll import their products and distribute into India already. So like I said, they've been operating since 2006 in India, pretty well-known brand. Now they've got private equity backing, like a big push to actually get their Indian growth story going as well. And we're very excited to be a part of that journey.
So maybe to complement is, so we will own 60% of that joint venture, with them 40%, owning 100% of the production, but also the distribution in India. So that's a new venture that we will inform you as we go, and we'll see in which framework we will report about it. Thank you, Mark. So now we'll go through the clusters. So hotel and resorts, I think that many of you have probably gone through the analyst meeting, so I'm not going to go through the details, but as I mentioned, we're very happy with the performance of Sun Life. I think that from a ratio perspective, they are best in market ratios, very strong management team, very good momentum. And our strategy was to have Sun Life as a yielding asset and vehicle with real estate, which is now resulting in excellent results. And then from a Riveo perspective, Shangri-La relaunch is a success. The momentum is good. And Four Seasons is going to open beginning of November, so which is going to be a big driver for the Riveo going forward. So we hope that, let's say, the next financial year will be a full year for Riveo, where we will see the benefits of Shangri-La and Four Seasons as well. So very solid performance from our hotel and resort cluster. So I'll hand over to Eric to cover the textile. Thank you.
Okay, so good afternoon. As you can see, last year we had a growth of about 6%, which came actually entirely from our development in India, not from Mauritius and Madagascar. And EBITDA, the profit after tax, have been pretty stable over the last 2 years. Now looking ahead, we see the big focus is our presence in India. We've been in India since 2004. Actually, Guillaume and myself spent 2 days with the team last Friday and Saturday to evaluate all the opportunities we have from the landscape. Obviously, we have a bit of setback with a 50% tariff at this stage, though the US is actually below 20% of our business in India. So that may some sort of slow down a bit the growth until such time the tariff are being reset, which we all hope will happen. But again, it's the right place to be. And actually, our presence in India is mainly driven by our woven cluster, the shirt division, which accounts to more than 65% of CIEL Textile. And as a matter of fact, we have become, over time, between Mauritius, Madagascar, and India, one of the top 5 leaders in woven shirts globally in the world for mid to up market. So that's something which is remarkable. We dominate the market in India, clearly. We are well ahead of the competition, and we see a lot of potential for expansion in the next few years. Maybe I will link it to the point number 4, because we, like most industries, but maybe more ours, because typically textile is an old industry, we see a huge of potential to enhance our operational excellence and value proposition through a quick adoption of a digital transformation. And obviously, being in Bangalore, it's the right place to be. So we have a team over there, which we're giving a lot of backup and investment to really kick off and accelerate in a big way, actually 2 years, in the next 2 years, so that we can be ahead of competition in that matter. And really, we have some very amazing projects. Maybe after, when we have a drink, I can share some with you. And we see really a super potential coming from India in that respect. The second part is Mauritius and Madagascar. L'actualité, c'est today, AGOA expired today. So despite the many lobbying, we have no extension for now. We heard from the Financial Times on Saturday that the White House was in favor of an extension of 1 year, but this is yet to be confirmed. So that there is enough time for renegotiations according to the Trump's new trade policies. So we shall see. But as of tomorrow, we might be out of AGOA. So obviously for Madagascar, especially the US, is more important. But talking to our customers, the whole focus is to maintain the collaboration, which I have built up over time, and we shall see along the way. The third point is our needs division has been losing money for the last 3 years. So the recovery of that cluster is on the way, and it's obviously a priority. And the last one, or the first one, is people. So the big point is, because we're seeing a lot of potential for growth, especially in India, getting bigger. We employ a lot of people, 23,000 people. If we grow by, we see a potential to grow by 30 or 40% over the next 3 to 5 years. We need to recruit and employ a lot more talents to manage the business development with new skills at the same time. That's it. Next one. Oh, in Madagascar. Okay, the event in Madagascar, I already forgot. No, so we had obviously some disruptions since Thursday last week. We had to close our factory on Thursday, Friday, and yesterday. All our factories are back to work today. So we are mainly based in Tana and on Sirabe. On Sirabe, it's fairly quiet. Tana is still, as you may understand, more challenging. So there are quite a few unrest in the afternoon, but we're still running for today. We plan to work tomorrow, and we shall see how the situation evolves. For the time being, we are focused on our people, first and foremost, making sure that everybody is safe, protecting the assets, so that when the situation stabilizes, we can run normally. But today was good news, so we shall manage the situation as long as we move on. Actually, it's not the first time of our presence in Madagascar, so bad news, but it happens from time to time. Just to share that we are very well covered for the political risks. So if ever the situation was to deteriorate, on that sense, we are well covered. Thank you.
Eric?
Style finance.
Good afternoon, ladies and gentlemen. So finance had a very set of subdued performance. While revenue was up by 8%, we had a decrease in EBITDA of 10% and profit after tax of 9%. As Guillaume mentioned earlier on, margin compression and adverse market conditions has dented the performance, more so in Madagascar. I'll kick off with Madagascar. We've seen the what we call cash reserving requirements of the country go up by 6%, 2 times 3%, which basically means that out of our depositor base, we need to keep an additional 6% non-interest bearing at the central bank. It's a tightening of what we call liquidity and credit, to a certain extent directed by the IMF to Madagascar, for Madagascar to draw on their lines from the IMF. So this has impacted the margin in BNI, notwithstanding the fact as well that the base rate of the bank, central bank, has also gone up, meaning that the cost of funding has also gone up. Coming to Mauritius, we had also a soft growth of our credit, which didn't go to our expectations and didn't convert into the expected level of profits. That said, the ROCE on the cluster has been well above our expectations, around 30%. So that's a bit the market conditions in Madagascar and Mauritius. I'll just touch a bit on the impact of the recent events last week. We witnessed rioting in primarily the capital, some civil unrest outside of Tana, in the main cities. However, pleased to share that we operated normally yesterday, but though for limited hours. There's a curfew in Madagascar at the moment, and therefore we wanted our people to close earlier and get back home earlier. Today is a normal day of operation, not only for the banks, but also for the broader economic sectors, more so in distribution and sales. So that's the current context in Madagascar, and we expect, yesterday the Prime Minister and his government resigned or were removed by the President. Hopefully a new government in place, more stability, and some momentum for economic activity to resume to normal conditions. Way forward for the finance cluster into 2026, in line with the current context, but also since last year, we want a strategic refresh led by leadership changes, which we expect to execute as from now into next year. We also want to accelerate our digital transformation. So we've just launched our app in the Malagasy market. Has been well taken, 30,000 downloads in about 6 weeks. We understand it's the most accepted app and functionality in the market, and innovation in that space will be round the corner with added services. We just want to accelerate that so that client acquisition and growth sustains itself. Hopefully, this converts the customer experience and how the take-up comes up to be measured and to be seen beyond the services sector. Coming to the Mauritian environment, Bank One, with a new CEO being appointed, is also reviewing the target operating model and aligning our activities and strategy to chosen client segments. So we expect this to be in full swing by the end of this year, with all resources and appointments completed where changes are warranted, and that the operating model is fully operative for the next financial year. Have to be clear, financial year of Bank One, which starts as 1st of January of 2026. We also want to accelerate our digital, being banking in our digital activity, and hopefully this will be the fixing the basics, as we say first. So basic services like mobile banking, internet banking, which we know hasn't been to the expectations of our clients, and building from there, extending further services digitally, as clients now are looking, especially in the cross-border space, for more digital interaction and more tech-led solutions meeting the expectations in terms of service. So in a nutshell, enhancing our digital offering, driving client experience, hopefully margin back to normal levels, and that Madagascar itself resumes normality, though with the events of last week, maybe a slowdown or a break, at least for this quarter. Thank you very much.
Good afternoon.
Bon après-midi tout le monde. So on the healthcare sector, we had a good year, I would say. We are in a good momentum in Mauritius, and I would say an excellent momentum in East Africa. So we grew our revenue by 18%, and we grew it both Mauritius, Uganda. I would say more in Uganda than Mauritius, but we are coming from a lower base. Also from an EBITDA perspective, despite all the HR costs we were impacted by in Mauritius, we managed to grow our EBITDA margin quite significantly in Mauritius and in Uganda, thanks to all the investment we have started and the strategy we have started to implement post-COVID. And obviously the path also, I would say, is a result of all the initiatives. So for next year, from a group perspective, we are continuing our restructuration at group level. Now we will be 100% owner of our CIEL Mauritius assets, same in Uganda, 100%, and we were already 100% of our small medical center we opened in Madagascar. Also continue our expansion strategy, mainly in Kenya. We want to be safe, we want to do things well. It's not an easy market, but we are really on the outlook there. From a digitalization perspective, we are rolling out all the digital framework from a quality perspective, auditing perspective. We believe that we will succeed our East Africa positioning by an excellent operational excellence framework, and we use digitalization to control all our assets from Mauritius. And for us, very important for the year to come is our EVP. We need to work with our talent to really retain. That's one of our biggest challenge, I would say. Even though we are much better these days than what we were before, it's people to serve people. So it's where the things are very important for us from an employee perspective. Mauritius, we continue our growth, I would say, addition of new rooms, ICU renovation at Darnay. We will expand the capacity of Welkin. We are also continuing the addition of our Dencare strategy. I think we presented it last time when we had the deep dive, where we entered now a new stream of dental. Also, the diagnosis center, we are increasing the number of C-Lab we have in the country. And our app, we have the next phase of our app. We will launch the phase 2. We learn from the launch and now improving. And we recently also launched Hop, where you can order your pharmacy product from the platform, Hop platform. If you have not tested it, please try. Uganda. We continue also our expansion. We are adding a new hospital in Bara. It's a suburb area in Uganda. Also adding new clinics in the country. Also, we are commissioning new equipment. The MRI we put in place last year has been booming, and we are doing very well. The momentum is really, really good for us there. and Madagascar. So we are small. We were not really affected from an asset perspective by the crisis, but we need now to really be close to the team and make sure everything goes well. It's small, but we are convinced that we have a role to play in the region and in Madagascar. So thank you very much.
CNN.
Good. So good afternoon, everyone. On the property sector. So I'm pleased to report on Evolis this year that what we have started a few years ago about regeneration of building for the Evolis properties is now completed. We have a full portfolio fully renovated with almost 98% of occupancy on a 80,000 square meter rental spaces. Now, for next year, what we want to do is to continue with strategic acquisitions to expand our spaces for rental by almost doubling within an acquisition that we are currently considering for this year. From a profitability perspective, I do believe that we will see the full extent of what we have done over the past years. We will have a full year with a full rental impact on our bottom line. The revenue for this year, you can see it's increased. It's mainly fueled by Evolis properties, although the EBITDA and the PAT for the cluster are impacted by what Jérôme and Guillaume were mentioning about a one-off sale of land in Ferney last year. So we will continue to ramp up on our revenue contribution for Evolis this year with the acquisition, but also by testing the market by exploring new greenfield projects on the adjacent land in our existing property portfolio. We're also rolling out our digital app. We have already started rolling out our digital app. We want to enhance the customer experience with our digital app, as well as create an operational efficiency in our operations for Evolis properties. On Ferney, we have some delays, but this year we will deliver our first project, very innovative project, which is farm living. We have already secured 95% of sales, and we will be delivering that in the few months to come, and we will see the impact over the FY26 year. We are also completing our phase 1 infrastructure in Ferney. So we will all see now the new Ferney, the new visage de Ferney early 2026. With the success of farm living, we are planning for a second project, which is in line, not the same, but in line the same philosophy as Ferney farm living. And we are also looking at, we have already built 3 bubbles, which will be soon in operations to broaden the eco-hospitality activities within Ferney. So that's it. Thank you.
Thank you.
Thanks, Jean-Noël. So last but not least, the agro cluster. So I believe a lot of you have been invited and attended the MIWA session last week, and we have a session with Alteo next week, next Wednesday. So you have more details, but just to give you the main highlights, we have had a decrease in the contribution. So to remind the audience, we have a 21% stake in both Alteo and MIWA. And with the decrease in the sugar price across our markets for different reasons. I mean, in Europe, the price is down. In Tanzania, we had a lot of imported sugar in view of the forthcoming elections, which has really put a lot of pressure on the local price. And also in Kenya, where the price was lower than the previous year. So this has impacted on the results. Hopefully, things are going to change very soon. I mean, we can see that in Tanzania already the sugar price is picking up. Kenya, the performance is better this year, so we should have improved results from the MIWA front. And on Alteo's front, even though sugar price is expected to be even lower this year, but we can see that the transition from a sugar industry to a property play, which has been the focus of management over the last few years, is paying off. And we can see through the agricultural sales of land and the development, now with Anaïta Beauchamp, just at the back of Anaïta IRS project, is yielding very good results with all other property development across the east and north, like Montpiton and Soléa near Trou-de-Douce. So there's a lot of projects ongoing, which is helping to mitigate this shortfall in the sugar price. I think the focus from the Mauritian operation will really be on lowering costs of production, and therefore, working towards this, we are increasing the land mechanization. We have a plan up to 2035 to bring 100% of the land under mechanical harvesting, and this should hopefully bring some results. We are putting a lot of emphasis on special sugars, which comes with a premium on the market, which helps in terms of contribution to the operations. So yes, it's been a challenging year. Yes, the sugar price is under pressure in Mauritius, I mean, on our traditional European market. But with opportunities, we are currently working on a distillery project in Tanzania, with energy projects potentially in Kenya. This could give a lot of opportunities for MIWA and the agro cluster of CIEL. Thank you. Pass on back to Guillaume.
Thank you, Jérôme. Thank you. So maybe a word on ESG. So you all know we presented our ESG framework, I think at all the analyst meeting. In our annual report, you have a very comprehensive sustainability report. So we don't want to go through it again. I think that you all know of our commitment towards ESG. But we just wanted to highlight that this year has been marked by the launch of our CIEL Sustainable Finance Framework. We have also a clear roadmap now for our renewable energy strategy to reach 80%. And through our foundation and all our clusters, everything that we do in East Africa, Asia, we reach out to 200,000 beneficiaries from a social perspective. So looking ahead, we really want to now to leverage on the clear framework that we have to accelerate the strategy that we are executing. We are also aligning sustainability disclosures to IFRS S1 and S2. So we are working and preparing for that. And one element which was missing in the environmental part was a climate risk assessment. So we've launched that this year so that we can have a comprehensive climate risk assessment and management system. Now, regarding the outlook, so I would like to say that we are very much focused on our strategy, the strategy execution, and our core business. So operational performance for us is important, and disciplined capital management. From a hotel and resorts, so the reopening of our assets, being mainly the Four Seasons, will be very important for us in the upcoming year. And we are still focusing on positioning Sun Life and Riveo with a much stronger contributions for the financial year onwards. From a healthcare perspective, we want to advance operational excellence to enhance efficiency and patient outcomes. And there's also the East Africa expansion. I'll talk about it. So very focused on what we are doing and doing it better. From a property perspective, the Everlist portfolio growth is progressing well, and fairly long-term value creation is also being unlocked, and we will continue in that direction. The textile, we need to keep agile and navigate the current context. Comme Eric a dit, c'est de l'actualité that we need to manage. But we are very much focused, as Eric mentioned, on our medium to long-term strategy in India, and we believe that there's a lot of value to be unlocked over time. From a finance perspective, we go back to operational performance of Bank One and BNI. With the leadership change that Lakshman mentioned, we have a high expectation and a lot of attention, I would say, from the leadership team of CIEL and CIEL Finance. From an adjacency growth perspective, so real estate is important. We've seen the success of La Pirogue Residences, the cash that it has unlocked, and additional rooms that we are now offering to La Pirogue, which is running at 90% plus efficiency. So we see a lot of potential in that. So we're going to do it on Shangri-La Villas, and we're going to do it on the Long Beach as well. And the healthcare, as Hélène very well presented, very much focused on East Africa. I think that's what's important when you see the growth in Uganda. It doesn't come by chance. I think it's been a lot of years of getting the model right, getting the pricing right, the services right. Do we put an MRI or not? And I think that the team now, based on data, very strong data and expertise, they got the model right, and the expansion is progressing extremely well, and we want to accelerate that by remaining cautious at the same time. And then we will have a lot of focus on our new joint venture in India. So Mark, myself, and the whole team spending a lot of time in India to launch our new operation in medical device manufacturing, leveraging on the CIEL Textile teams in India, where they have a know-how of the market and how to set up manufacturing. We are very much excited about it. Very good partnership. And so this is something that we are driving quite hard. So focus on our core. We know what we have to do. Strategy execution. At the same time, some interesting growth drivers that we are nurturing for future growth of CIEL. So that's a conclusion from my side. And I would like to thank the CEO and everybody for organizing, and all of you for being present or online. I'm sure that you may have some questions. We are happy to take the questions either to the CEO, the cluster CEO, or to myself or Jérôme. Thank you.
Thank you very much. Maybe, Guillaume, I start at the very end or at the beginning from what Mark was saying. I'm still trying to get my head around this new venture and how the skills from sewing a shirt can be transferred into manufacturing a hip replacement. And the other thing is the target market, because obviously the market in developed markets is dominated by players like Stryker and Zimmer Biomet and so on and so on. So did I get it right? You're mainly planning for the local Indian market or emerging markets in terms of the target market. And if you could expand a little bit more on that whole venture, because obviously it's extremely exciting if it works and when it works, but we need to get a bit of a better understanding of.
Yeah, so maybe I'll start with the DNA first, just to understand that from a CIEL perspective in our growth, with most of our ventures has been done with very strong partnership. So we didn't necessarily had the know-how of the industry, but we chose very good partners and we nurtured the partnership. We've done that in India when we went for formal shirts. We didn't have the know-how. Yes, we were in textile, but we had a very good, strong partnership. So knowing the Indian environment is very important because it's a very exciting market, but extremely competitive. So knowing the Indian environment is very important, and we feel that we understand. We have 10,000 people now in India, or a bit more, and we wanted to leverage on that, but we needed to have somebody with the expertise. And we have also worked with. We have a lot of consultants who are ex-CEO of Zimmer Biomet, so advising us into the process. So it's not something that we just thought about. It's something that we've been working for 2 years. We looked at acquiring, but in India, the multiples are very high. And as we are long-term investors, we say, if the multiples are so high, why don't we start from greenfield and harvest it over the next 10 years? So that's the introduction of maybe the why, and I'll hand over to Mark.
Just to be a bit clearer on, like, it's not shirts. I mean, Eric's team are not going to manufacture knees, right? So maybe I wasn't that clear up front. So I guess from our context, we need a partner with the technical expertise. We don't have it. But from a European company's perspective, they're looking at India and think, well, like, it's a big, scary place. And we are leveraging CIEL Textiles' credibility in terms of being there for 20 years, having, I guess, the manufacturing as a CMO concept, and also, like frankly, I guess the governance structure of CIEL. So in terms of, we've got very strong governance. We actually have some very big institutional French shareholders in CIEL, so that provides a lot of reassurance. But like Guillaume said, we started this project, and the big thing for the project is distribution existing, which is that distribution business is coming into the joint venture. But the big thing is setting up a factory. So we've had 3 key consultants who are all ex-CEOs, or one of Zimmer Biomet, so from a distribution perspective. So he headed up Zimmer Biomet Asia. The other gentleman was with Makino, which is one of the largest CNC, so computer numerically controlled machines, these big robotic machines that actually do the precision engineering. So he set up 15 factories with them and other businesses in India. So he's like the guy leading our factory setup for us. And then we've got one person as well who was he was the manufacturing director of a big US contract manufacturing outsourcing business in California, and then moved to India and spent 10 years setting up the factory there and driving a business there. So I guess we've got 3 heavy hitters that have been working with myself and my team and Guillaume to drive this. From CIEL Textile perspective, we've obviously got some fantastic support from a finance, HR, IT perspective to help us like shared service to really drive that side of setting up the business. And then from a target market perspective, like effectively you've got low cost product, which goes into government hospitals, and that's the Indian OEMs. So you've got Indian manufacturers that are manufacturing. And then from the private sector hospitals, which is growing more and more, and is huge already. So for premium product, that's the MNCs, so the likes of Stryker, Zimmer, J&J, or Dupuis Synthese, Smith & Nephew. So they're the big guys in there. And Evolutus is in there. Small market share now, so like 1 to 2%, but very strong in shoulders. They're one of the market leaders in shoulder, good in hip, and they haven't been distributing knee because of the price cap. Yeah. So it's kind of, that's what we're looking for. But it's a big market. So 540,000 knees at the moment a year going into Indians. So half of Mauritian population. And that's scheduled to grow a lot bigger. So I guess the sheer scale of it is huge. Like it's, yeah.
Yeah, and maybe to add is, we go to India often, and Eric, and when you start understanding India and the potential, it's quite massive. And where you see where we are in textile now, in manufacturing, where 75% of the profits of CIEL Textile come from there. I mean, you cannot not try, and medical, we know healthcare. So we have some understanding so we had a very good team in place. And yes, certainly it will be challenging. It's a new venture. But is the risk worth the opportunity on the long term? Certainly. If you asked me to buy a business for 20 times EBITDA, which is the norm there, I would maybe say, okay, maybe not. But now with the right partner who has the expertise, with our know-how in launching the project to harvest over the next 5 to 10 years, I think it's worth it.
And just maybe one more point. I mean, like CIEL's got a big focus, obviously, on building strong teams with great talent. So that's been a focus of us and the partner that we're working with. So recruiting first, head of manufacturing, for example, head of distribution, head of like the regulatory, and that's a very structured process. We're going and getting people out of the likes of Stryker, Zimmer Biomet, etc. So these are executives with 15 to 25 years of experience in India, working for multinationals that are coming into this business. And a part of the deal is that there's a knowledge transfer into manufacturing over the next few years as well, from like that company's specific manufacturing processes.
So, and this will fall under manufacturing. So it will remain under manufacturing. So we will have textile and medical device manufacturing.
Yeah, maybe a quick question on the tariff. So for the textile sector, for Mauritius it's 15%, and for India I think it was 25. Then
50.
yeah, it's like 50%. Yeah, but how is so when you are exporting the Indian products to the US, you're subject to 50%?
Yep.
Okay, and for if it was Mauritius, it's 15.
Up to today.
Yeah.
As from tomorrow, it might be 15 plus 16.
Because the non-revenue was
15 plus 16 as well.
But is it possible like to switch from for example, from the manufacturing in India
No,
to
it's a
other
possibility. So this is something which we are talking with. Actually, we have a lot of common customers between what we do in Mauritius, Madagascar, and India, so we can swap. The other element is our two largest USA customers from India are global brands like Levi's and Polo Ralph Lauren. So what we do for Levi's, 30% goes to the US, 70% goes to the rest of the world. So what they will do is for the next season, place the USA orders into other Asian countries and add up volume to us on the non-USA side. And same goes for Polo Ralph Lauren. So that's why there will be an impact because there will be less opportunities in terms of volume, but that will not some sort of stop our business development in India. Probably the speed of which we had anticipated a big growth in the next 24 months in India, that's likely to be slower. On the other hand, it's crazy because China is 30%, India 50%. It doesn't make sense from a geopolitical point of view. So there are a lot of back and forth discussion, and everybody believe that it will not stay. But when is that going to change? We don't know. What we can see as a matter of fact is that quite a few factories in textile in India are highly dependent on the USA market, and for them it's difficult. That's for sure.
I just wanted to expand that question. Like, in India, there are so many textile companies are there. Like there are, Raymond is there, and you got Arvind Fashions, and a lot of competition which is there. So how do you envisage to combat this competition and at the same time grow in the market?
We are far ahead. We're not competing with those guys. Arvind is mainly fabrics, big time. So their big business is fabric. They ship a lot of fabric in many places. They have apparel exports. In our category, it's pretty small. They do actually maybe 6-7 million shirts a year. For export, we do 20. And Raymond, there's a high focus on domestic market and suit. So they're not direct competitors to us. They again, in our product category, which is woven shirt, we lead the market by a lot. And we own all the premium brands who want to source from India. And actually, we see a lot more potential. Not sure why, but that's a reality.
Thank you.
While you're standing.
Yeah.
Can I just ask a bigger question in terms of the changing or not changing landscape of consumer taste and things like that? Mm-hmm. Because obviously you're exposed, or you mentioned some of the premium branded kind of apparel products, but I'm a bit confused of the signals of what I'm getting from when I listen to some of the listed companies. I mean, Inditex, Zara doing extremely well. Then we had Primark having very bad results. So how is it at the moment in terms of the positioning where you are the I would say premium and branded relative to the no names? In the past, you used to have a big exposure to ASOS. Also, that is not so. So how is the overall landscape at the moment? How do you see that changing?
If you read through the financial reports, the best company win. So in the premium segment, let's say Polo Ralph Lauren is doing extremely well, led by a French guy, by the way. So it was at the same university as me at the same time. Hugo Boss is faring pretty well as well. On the value one, some guys are doing well. Primark was not as good as expected. So it's a very diverse situation. Inditex has been by far for the last 30 years the best in class in terms of EBITDA. So it's difficult to read an exact pattern. Now, from a product point of view, there's a lot of push towards more synthetic fabrics, performance garments, and athleisure. So which we mainly do from India at the same time. So yeah, plenty of opportunity at the end of the day. Again, before tariff, India was the right place to be. And we're just wondering where to buy more factories and land. So we'll be a bit on a wait and see because the US is a big market anyway. In the meantime, actually, I haven't mentioned, but India has signed a FTA with the UK a couple of months back, which will be fully implemented next year. And again, because of the pressure of the US, Europe, which has been actually negotiating with India for the last 20 years, is actively pushing to sign an FTA potentially by the end of the year. which again will open up a lot of opportunities. What is specific to India as compared to Vietnam, Cambodia, and Bangladesh is India, as the gentleman mentioned, have got a very solid textile industry. So when we produce garment in India, we use local cotton, local fabrics. So it's totally vertically integrated and immune to any Chinese content. So that's a big element. And the rest, it's a huge country, massive population. Talents are plenty across, not only on technology, but management-wise. We have fantastic leadership team. Actually, our CEOs in India have been working with us for the last 20 years. I mean, that's kind of crazy. And when you see the dynamic of all those engineers, tech people in India, yeah, I wish I could be younger and be based in Bangalore because there's so much we can do.
Yeah. And maybe just
I will do so.
just to add also what's important maybe from a macro perspective, it's true that Mauritius, we've been, for the last 20 years, we've been shrinking. Madagascar for us is a pretty stable. Okay, now there's some actuality. It's more of a yielding asset for us. But then when you go to India, the government, everybody wants to make India a manufacturing success. So you have really this, this push. And so it's really encouraging because you know that you are investing into a place which is based on the long term. Okay, there's a US tariff. We need to deal with that. But the momentum is extremely positive.
Last questions? There's no questions online. Okay, you get one more turn.
Sorry. Yeah, I wanted to come back to Lakshman on the financial cluster. And you said, especially on Bank One, the new CEO is now in the job for about a year or so surely has reported back some initial findings. And you kind of mentioned something like there's a strategic review or what. So I'm just wondering, is it more like, let's say, a drastic surgery needed or more like a homeopathic change, if I use a analogy to the healthcare cluster?
Neither. Homeopathic, we typically don't know what will be the outcome, but we claim it works. Okay. And dramatic surgery, no, the bank is not in a intensive care unit. As every new CEO that comes, they look into what has been happening, what has worked, and they bring their own flavor. The newly appointed CEO is a Mauritian and has worked extensively in this market, both for the onshore and offshore segment, which hasn't been the case for quite a while. And we believe that his understanding of the market and the dynamics of where the opportunity is will bring value add, and how he wants to organize teams and products to meet our client expectations in specific segments. We are not trying to boil the ocean here. Is his focus. So he's been busy building for that since he arrived. Hopefully he fill in a couple of last seats and moves on to more accelerated business activity. I'm not saying business activity wasn't there, but we are hopeful that this accelerates. That's a bit what I can say. So neither or for now, hopefully. Thanks.
Maybe on BNI. So you mentioned that there was a margin compressions and you're looking to make the margin go up again. And what factors could contribute to the margin going up again? Yeah.
Well, banking is about lending and taking deposits. What has happened with the suck up of deposits by the central bank as a monetary action, we need to grow our deposits and have more liquidity to meet our growth in loans and advances. Right now, we are funding the bank out of the interbank market, which is quite pricey relative to retail deposits. So we need to accelerate that, and hopefully favorable margins are back, notwithstanding pricing our credit higher. where applicable. It's a competitive market, so we need to price our loans appropriately and recoup a bit of that pinch that has happened from the regulator. But the crux of the matter is to raise cheap deposits. It doesn't happen overnight, and as it happens, I think margin will be back.
Maybe if I can add, I think that we believe that il y a des gisements d'amélioration within the operations themselves. So clearly, there's a market conditions that you need to deal with, but certainly we see opportunities to do better operationally, and this is what we are really focusing on with the change in leadership at both banks now coming.
Okay.
Good.
Thank you. There's no more questions online.
Thank you very much. Thank you for the questions, and thank you for attending and online and in person.